All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Tuesday, everybody. Today is August 25th, 2026. And our top story this morning, it is Scott Bessent versus the world. And mostly because I really enjoyed that movie and because it really is Scott Bessent versus the world right now, we are going to talk about what Scott Bessent needs to do if he wants to remain as Treasury Secretary, if he wants the dollar to stay as the world reserve currency, and if he wants to keep seeing Ramona, then he's got to defeat the dollar's seven evil X's. We're going to have a little fun with this one. The first one today, the first of the seven evil X's, is Iran. Yesterday, Bessent announced economic D-Day, which was, this big hoopla about the new round of sanctions. As expected, it was kind of a lackluster announcement, and we all kind of knew what was going to happen, all right? Iran has been sanctioned for decades. This is not new. They have survived because they've still managed to do business with other countries who don't care about our sanctions. And so if we want these sanctions to work, we've got to sanction these other countries. So first of all, the first foe that Scott Bessent has to fight is the Iranians, and he came out with those sanctions yesterday. Now, if he wants to implement those sanctions, then he really has to fight the next of the dollar's seven evil X's, which is China, who buys 90% of Iran's crude oil. If Bessent is serious, and if we are going to use this new sanctions regime, which many doubt, there's a lot of calls for taco, and rightly so. That's been the way of things for the last year and a half. But if he wants to put these secondary sanctions on Iran, he's going to have to deal with the Chinese, who buy 90% of that oil. And if he does put sanctions on Chinese, let's say he targets ICBC, the biggest bank in the world by assets, the big bank in China who buys most of that oil, finances the transactions. If Bessent puts the sanctions on them, then guess what? It's Liberation Day all over again, and the trade war is coming back. And the bond market freaked out the last time that happened. And isn't Bessent trying to keep yields lower? Yeah, good luck with that if there's the rekindling of the trade war between the U.S. and China. Now, look, some people view that as inevitable, right? Like if the Chinese roll on Taiwan next year or in 2028 or whenever, which most people think it's inevitable that the Chinese are going to invade Taiwan, what's the first thing they're going to do? Is they're going to sanction the Chinese. So this is going to happen anyway. Maybe they're finally recognizing the inevitability of this confrontation. Or maybe they're just going to taco once again, like they did several times over last year. Now, the next of the dollar's seven evil X's that Bessent has to fight is inflation expectations. And that's really what's been pushing the interest rates on the long end of the yield curve higher, which is why Bessent has been intervening all last week and all this week with these jawboning episodes talking about increasing Treasury buybacks, something that Stan Druckenmiller had a fantastic op-ed in the Wall Street Journal about. We're going to talk about that one today. The more people expect their dollars to become less valuable over time, the higher interest rate people are going to demand in exchange for loaning that money to the government, because by the time the government pays you back, it's not going to be worth anything. And so you want a higher interest rate. So inflation expectations need to be overcome if Bessent wants to keep yields lower. Now, of course, the way he's trying right now to keep yields lower is through these Treasury buybacks and all these gimmicks that Druckenmiller's correctly calling out. So now Bessent has to deal with the bond vigilantes. And the bond vigilantes, it's not this group of guys wearing a red beret who go around the streets selling Treasury bonds. No, they're large institutions that sell treasuries because they view what's going on in Washington, D.C. as reckless fiscal irresponsibility. And look, we're at like peak fiscal irresponsibility, 2020 notwithstanding. Nothing has gotten any better. We are unserious about addressing spending problems in this country. I mean, is anybody even talking about cutting spending anymore? I don't think either party is even paying lip service to it at this point. And so Bessent has to deal with the bond vigilantes. Bessent also has to deal with the yen. That's another one of the $7 evil X's that he's got to fight. He's been propping up the yen since last week as well, that big intervention. Remember the piece of paper he put out, buy yen, and then they published it because he's worried the Japanese, who need dollars in order to buy more expensive oil, they're worried that the Japanese might sell U.S. treasuries in order to get those dollars. They're also worried the Japanese are going to sell U.S. treasury debt in order to sell those dollars to buy their own currency because the Japanese yen is falling for all the same reasons the US dollar is falling. And so he's got to deal with what's going on in the yen. And Bessent has to contend with the Federal Reserve, which right now, what Bessent is doing is he's basically daring Kevin Warsh and the Federal Reserve to bankrupt the government by raising rates. Scott Bessent is buying a whole bunch of long end bonds, or saying he's going to, starting in September through November. He's going to buy a whole bunch of long duration bonds, and he's going to sell Treasury bills in order to pay for that. Well, if the Federal Reserve goes and hikes the overnight rate, that doesn't do anything to the long end of the yield curve. That raises the short end of the yield curve. And all of these Treasury bills that right now Bessent is selling in order to buy back the longer dated stuff, all of these T-bills that Bessent is leaning on, they get more expensive real fast. And that stuff has to roll over every month, every 2 or 3 months. That stuff rolls over. And if the Fed starts hiking rates again, that's going to get more expensive. It's going to balloon Bessent's borrowing cost. And of course, if Warsh doesn't raise rates over at the Fed, if they don't raise the short term, then the bond vigilantes are going to come back in and they're going to start selling the long term. And the whole reason we're talking about all this shit is because Bessent needs to keep the long end yields lower. And last but not least, and mostly because I really need the list to be 7 long, we're going to throw Congress and the president on there as well as the evil exes that Scott Bessent needs to fight, because the whole reason Bessent is in this freaking mess is because for 50 years, the United States has spent way more money than they take in. We have no end in sight to this problem. It's actually getting worse. And with World War III on the horizon, let's be honest, guys, they're just not going to cut spending. We had this whole silly episode at the beginning of 2025 that we called Doge, and everybody's like, oh my God, they're cutting my favorite social program for handicapped comic books in Bolivia. Or I don't know. But all the stupid shit that they cut, it didn't matter. Within a week, they had spent more than that on something else. And now with all the conflict, remember when we were going to spend less money? And remember when we were going to have no new wars? Yeah, about that. So look, Scott Bessent versus the world. He's got to fight Iran, China, inflation expectations, bond vigilantes, the yen, the Fed, and Congress and President Trump. So, hey, Scott, good luck with that. Talk about a job I would never in a million years. You could not pay me enough money to take Scott Bessent's job right now. Also going on this morning, we've got Bitcoin ripped overnight and then sold off this morning, trading pretty wildly between a range of 81,000 and change and 79,000. So is this a new bull market for Bitcoin, or is it a liquidity trap? Stick around. You'll have to wait and see. We've got Broadcom is back in the news. Their credit risk is soaring. Bond yields rising, CDS rising after pledging billions of dollars in financial backstops. Broadcom fancies themselves a little NVIDIA, going to act like the central bank of the AI trade, and, well, probably not going to end well. I've got another story that you need to watch. Apple has just launched a new Mac Mini. And yes, you need to care about that, whether you buy Mac Minis or not. Anybody with a pension, an IRA, or a 401k should pay attention to what Apple is doing with these Mac Minis. And I think, honestly, that could be a huge story in the making there. We've got the SEC has subpoenaed several big banks over the collapse of situational awareness. That's Leopold Aschenbrenner's hedge fund that spectacularly blew up at the beginning of August. And then, of course, Citadel came in, bought everything up for pennies on the dollar, and then sold it to FOMO investors at a profit, unloading most of that risk in just a couple of weeks. And now the SEC finally doing something, sniffing around what happened at that fund. And last but not least surprising story ever, Taiwan has indicted 9 people for chip smuggling, for selling AI servers to the Chinese, including Supermicro and NVIDIA employees. That thing that isn't happening just happened again. Guys, we got a lot to talk about this morning. Why don't we shrink my big melon of a head? Let's see what's going on in the world of finance. Don't forget that like button and that subscribe button for the algorithm, should you feel so inclined. Right now, the S&P 500 is higher by 30 points, 0.4% in the green this morning ahead of the opening bell. The Dow is up by 255 points, about 0.5% in the green as well. And the NASDAQ is leading the way higher, up 235 points, 0.81% in the green this morning. We've got the U.S. dollar is a little bit weaker here, 98.95, off by 4 basis points, going a whole bunch of nowhere this morning. Let's check in on the Japanese yen, shall we? We haven't looked at this one in a few days, and it's the same story over and over again. We get an intervention. It climbs back up. They intervene again. It climbs back up. It climbed for a while. And then actually, I went too far. They intervened here. It came right back up. They intervened here, and then Bessent intervened as well, and we came right back up. And then we had that announcement of the buybacks last week. The yen strengthened. And again, we're coming back up. It's almost like if you don't fix the underlying physical weaknesses that are making your currency less valuable, then it doesn't matter how much you intervene. Isn't that interesting? Perhaps this is a rather clearly enunciated metaphor for what's going on with the US dollar and what Bessent is trying to do in the bond market. If you don't fix the underlying problem, then Band-Aids accomplish nothing. They just buy you time and make the long-term problem even worse. Looking over at the bond market, though, we've got yields are lower again. You know, for all the criticism of Bessent, most of it justified. In the short term, right now, it is working. The 30-year yield is at 5.188. It's lower by another 4 basis points. Remember, the 30-year yield went as high as 5.33. So, you know, we're down by like 15 basis points here now since Bessent started jawboning and intervening in the long end of the yield curve. I don't think it's going to stay here. I don't think it's going to work, but in the short term, it has worked. The 10-year yield is at 4.65. That's lower by 5 basis points this morning. The 2-year yield, 4.208, off by almost 3 points. And the 1 month is relatively unchanged at 3.696. Looking over at Bitcoin, it had a pretty wild night. It's just been a crazy couple of days. Scott Bessent, since he announced that intervention in the bond market, has triggered a short covering rally, which risks becoming a FOMO rally in Bitcoin here. Bitcoin has rallied some 23% in just about a week. Currently, though, down $200, 78,770. Let's take a look at 1 minute candles so you can kind of see what happened overnight. Trading View, come on, give me my minute candles, Trading View. Don't do this to me while we're recording. Okay, here we go. Look at what happened in the minute candles overnight. It looks like the whales were jerking our chain because we had a big buy here, we had a big buy here, and then a few hours later, a big sell and a big sell, and pretty much we're right back where we started. So it looks like the whales were playing games overnight. Bitcoin, $78,796 here. Let's talk about what's going on. Bitcoin tops 80 grand. As bullish mood returns to crypto markets. We went as high as 81,200 last night. Bitcoin climbed above 80,000 for the first time since mid-May as optimism returns to the beaten down crypto market amid a confluence of bullish signals that forced the liquidation of billions in leveraged bets. That's important there, guys. What's happened in Bitcoin has been predominantly a short covering rally, or a short squeeze, if you will. That liquidation of those leveraged bets. People just got way too overly bearish Bitcoin, and they got cleaned out. The original crypto rose as much as 2.9% to 81,257 on Tuesday before reversing those gains to trade little changed. The token remains well below its peak of 126,000 that was reached in October. Bitcoin is back in favor as chatter about the debasement trade was renewed by Treasury Secretary Scott Bessent's announcement last week that the U.S. will step up its bond repurchases in a bid to lower long-term yields, sparking a fresh round of dollar selling. Skeptics viewed the plan as further evidence the Trump administration isn't yet ready to do the hard work of reducing the budget deficit. That's not speculation. They're not. They're just not going to cut spending, guys. Bitcoin was originally created as a way to escape fiat currency debasement and inflation driven by central bank money creation. It rallied 23% in the 7 days through Sunday, the biggest weekly jump in about 3 years, as Bessent's bond buying plan helped jolt digital assets out of months of sideways trading. The price of gold, another beneficiary of the debasement trade, also advanced. I would add, guys, that I don't yet think this is really a new bull market here. Still, skepticism remains. Some analysts have pointed to the short squeeze as the main driver of rising prices, raising questions about the sustainability of investor demand. One group looking to take profit now could be Bitcoin miners, who have been under severe financial pressure. The average cost to mine one Bitcoin was just under $80,000 at the end of last year, according to CoinShares. A move higher could prompt supply to sell from this cohort looking to monetize and de-risk their Bitcoin exposure. A bull market should not yet be treated as a confirmed trend. said Bitfire Research Director Alan Ding. If institutional participation, regulatory progress, and capital rotation continue to reinforce one another, the current move could mark more than a short squeeze. It could be the beginning of a new market cycle. Look, I could be wrong about this, guys, but I think it's still a little too early for this to be the new Bitcoin bull market. When Bitcoin finally does reach a bottom, it doesn't pop like it did in the last few days. It tends to trade sideways and grind slightly higher for about a year prior to the next halving. So this just doesn't look like a new bull market to me. I could be wrong about that one. Also going on this morning, let's look at the commodities board. We've got gold lower by $35, $4,616, or lower by about 0.75%. Silver is lower as well, off by $1.39. That's $67.55, 2% lower, but I still like the shiny, especially for the long term. Copper's higher by 0.25%. Platinum is lower by 2.4%. Palladium is lower by 3.25%. And crude oil down 3%, $2.58 lower for WTI crude, sitting here at 82.42. Let's take a look at the oil chart. We've now fallen a decent amount in 2 days here. We went into the weekend with oil at around $86, almost $87. Now we're sitting here at 82.5. There hasn't been any like deal or no deal. We haven't had any Axios articles about an imminent peace deal. I think it's the Jordanians or the Pakistanis are trying to get the U.S. and the Iranians to talk again, but they're not talking. So I think the reason oil is lower here is it's becoming increasingly clear that more oil is sneaking out of the strait than we realize. I think that's what's driving oil prices lower. There are still tankers getting hit on almost a daily basis. Almost every day, the UK MTO reports that a ship was hit either in the Red Sea or in the Strait of Hormuz. But it seems like some of these merchant mariners are just taking their chances in exchange for the money. They're risking their lives to run that oil through these bottlenecks, and a lot of them are making it. Not all of them, but a lot of them are. So for now, oil is lower. Also going on, here's the big one this morning. Bessent's Iran threat hinges on U.S. willingness to hit China. And this is why a lot of people are calling for a proactive taco here, because they just don't think Bessent will do this. And I guess we'll just have to wait and see over the next few days. Treasury Secretary Scott Bessent's threat to unleash an economic assault against Iran risks setting the U.S. on a collision course with China, its main trading partner. But that's only if Bessent actually follows through on a threat that the Trump administration has made before. And many are skeptical he will, especially when it comes to China, which buys around 90% of Iran's oil, as Washington tries to maintain a fragile trade truce with Beijing and avoid a global economic shock. On Monday, Bessent promised an economic onslaught against Iran's financial connections around the globe as President Trump tries to wind down his unpopular war in the Middle East. Bessent unveiled dozens of new sanctions on entities, individuals, and vessels, but the main thrust of a high-profile press conference was threatening so-called secondary sanctions against companies and countries that continue doing business with Iran. China is by far the biggest buyer of Iranian oil and serves as a crucial link to the global economy for Tehran. That means any effort to truly choke off the regime's remaining revenue streams would be extremely difficult without targeting Chinese companies. Trump has previously said the U.S. would impose secondary sanctions on any nation or company buying Iranian oil and never followed through. The move marks a pivot from threats of further military escalation toward a renewed focus on economic pressure. A campaign that excludes China isn't likely to have a substantial impact on Iran, but focusing on Chinese firms could prompt retaliation and potentially more pain for the global economy. That's partly because blacklisting Chinese companies risks opening a new economic confrontation with Beijing. Doing so now would fracture U.S.-China ties just weeks before Trump and Chinese President Xi Jinping are set to meet in September. Asked directly about hitting China with new economic measures on Monday, Bessent said no one is above the reach of U.S. sanctions, but that he preferred quiet diplomacy, adding, "We were not going to name names." So Bessent's kind of punting here on China in that press conference yesterday. Bessent largely deflected questions about China, said Craig Singleton, a senior fellow at the Washington-based Foundation for Defense of Democracies. That makes tactical sense ahead of next month's summit, but strategically it risks reinforcing Beijing's view that Washington is reluctant to impose serious costs on major Chinese actors. And again, if you're going to do this secondary sanctions thing, you have to put them on China. And if you're going to put them on China, you better be ready for the blowback. And historically, these guys have not been willing to take the blowback. So again, if you're going to do this, either do it or don't. And then if you choose do, live with the consequences. And look, I think those consequences are inevitable because I think the Chinese are going to invade Taiwan. And when they do so, we're going to end up sanctioning these banks and entities anyway. So I don't know, might as well get it over with, I guess. Meanwhile, we got this one from Stan Druckenmiller in his op-ed in the Wall Street Journal. This was very well put together. Let the bond market speak. Rising interest rates are a signal of trouble ahead, and artificially suppressing it heightens the danger. The Treasury Department announced on August 19th that it would double the size of its long-dated bond buybacks from $2 billion to at least $4 billion per operation, aimed at the 10 to 30-year sector and running from September 9th through November 4th. The announcement came after the 30-year yield touched a 19-year high. Yields fell within minutes, but by the next afternoon, they had round-tripped to levels above where they had started. The market's verdict was swift and correct. This wasn't liquidity management. It was price management, and a mistake far larger than the $4 billion suggests. Treasury's announcement gave the game away. It's justified the larger operations as liquidity support in sectors with consistent, strong sponsorship from market participants. But strong sponsorship is the definition of a healthy working market. There were no failed auctions, no dealer balance sheet seizures, no forced unwinds, nothing resembling treasuries in March of 2020 or UK gilts in September of 2022, the sort of genuine dysfunctional episodes that justify official action. Volatility was contained. The trading was orderly, not a malfunction, but the machine doing its job. Consider what the machine was pricing. Inflation is 3% to 4% and has been above the Fed's target since 2021. Unemployment is 4.1%, full employment by any definition. The deficit is running near 6% of GDP, a number America has never before produced in peacetime at full employment. Are we still calling this peacetime, by the way? Anyway, the national debt crossed $40 trillion the same week Treasury intervened. Net interest will exceed $1.1 trillion this fiscal year, more than the defense budget. The 10-year yield, even after the summer sell-off, sits at or below the economy's nominal growth rate. That means a borrower, the federal government, running 6% deficits at full employment with above-target inflation still funds itself at roughly the rate the economy grows. Historically, that configuration is accommodative, not restrictive of financial conditions. The bond market wasn't being a vigilante, as some would argue. It was being a pushover that had finally begun to clear its throat, and Treasury moved to quiet even that. Every basis point of artificial yield suppression is a subsidy to procrastination. Suppressed long rates sugarcoat the interest cost projections, shrink the apparent urgency, and let incumbents ensure voters that debt is someone else's problem. If Congress and the administration are unlikely to touch entitlements, even with the market signal, they are certain not to touch them without one. Whatever the operation saves in basis points, it will cost multiples in delay. And look, I'm not going to read the entire op-ed. I got to at least what I thought was the highlights. What Druckenmiller is saying is by blocking these pricing signals, Bessent is not doing anyone a favor. The market isn't breaking down. There's not dysfunction in the Treasury market. It's doing exactly what it's supposed to do. It's telling the government you're borrowing too much damn money. Stop it. And instead of listening to what the bond market, which is arguably the most powerful force in the world, instead of listening to that, the bond market, Bessent is saying, I'm going to manipulate the bond market, which is the height of arrogance. So Druckenmiller correctly calling him out. And again, Bessent he's fighting everybody right now. I don't envy the guy. I wouldn't want his job. I don't think I could do a better job than Bessent, but I wouldn't even try to do this. I would just let the bond market do what it wants to do, which they're terrified of. And just a reminder, guys, we got Jackson Hole later this week. Kevin Warsh is going to take the podium and probably say very little, but it's worth revisiting. As of right now, the odds of the Fed hiking at the September FOMC are just 40%. So there's still more likely, 60% likelihood that they do nothing here. Now, if the Fed does nothing, I think the bond vigilantes are going to sell treasuries, and I think the long end of the yield curve is going to start rising again. And Bessent is going to have to lean on those treasury buybacks. If the Fed does hike, if worse does come in and say, let's raise 25 points, well, then all these treasury bills that Bessent is issuing, they're going to get more expensive by 25 basis points. And look, those T-bills, they roll over every month, every 2 and 3 months. Unlike the 10 years, which is basically you borrow it and then you pay that rate forever. It stays the same. These treasury bills are constantly rolling over. The government's interest expense is going to get higher a hell of a lot faster if we're entering a new hiking cycle. And if we're not entering a new hiking cycle, then what the hell are we doing? Because inflation has been above the Fed's target for 5.5 freaking years. Bessent's fighting everybody. All right, on to the AI bubble. Broadcom credit risk soars on mega AI debt financing backstops. All these chip companies that think they're banks, they're not banks, and they're going to find out the hard way that being a bank is hard and painful when you try to do it haphazardly. Bond traders have ramped up measures of credit risk associated with Broadcom as it backstops mega financing packages for the build-out of artificial intelligence. The yields on Broadcom's 5.15% bonds that mature in 2031 rose about 14 basis points so far in August. The price of its 5-year credit default swaps, meanwhile, climbed 28 basis points over the same period, a larger amount than both Oracle and SpaceX. Those numbers are pretty staggering there, guys. A big rise in the bond yields. That means Broadcom's debt is becoming less valuable. That means investors are less confident that it's going to be paid back or demanding a higher interest rate for that risk. And credit default swaps, the price of insuring those bonds against failure, are getting more expensive. Again, that expresses a lack of confidence in Broadcom's ability to pay back their debt, rising 28 basis points. And this is worse than Oracle and SpaceX. Oracle's CDS has just been going up in a straight line, and SpaceX loses money. So investors are not expressing a lot of confidence in Broadcom here. Broadcom is in talks to raise more than $60 billion in debt for an AI chip financing deal that is expected to benefit Anthropic and other companies. While the proposal is still being ironed out, Broadcom could potentially guarantee a portion of a senior secured tranche. That's after it struck an agreement earlier this year to backstop most of a $35 billion debt package, while investors including Apollo and Blackstone financed the purchase of custom AI chips to lease to Anthropic. The rise in Broadcom CDS seems to me is more specific to their balance sheet than overall angst over AI investment, said Tony, how do you pronounce that? Drinka, investment grade portfolio manager at Impacts Asset Management, adding it was likely related to expectations of additional financing guarantees by Broadcom for chip financing deals. The use of guarantees and other forms of financial support have gained pace this year as tech companies invest billions to expand cloud computing capacity. Under these agreements, chip makers like Broadcom or NVIDIA are effectively lending the strength of their balance sheets to their clients to boost their purchasing ability. In other words, they're backstopping the debt their clients are taking out to buy their own product. That is in addition to giving their clients money to give right back to them. This is raising concerns that risks are accumulating that are not visible on the balance sheets of these companies, and that in an industry downturn, similar backstops could force them to honor billions in pledges when their own earnings are under pressure. That last sentence is so important. These backstops could force them to honor these pledges when their earnings are under pressure. Because in any scenario where an Anthropic or any of these data center operators can't pay for these chips, and all of a sudden Broadcom or NVIDIA needs to implement these backstops, well, if they can't pay for their chips, that means Broadcom and NVIDIA's earnings are taking a dive right as their expenses are getting bigger. This is the same reason why you don't put the fire extinguisher right next to the stove, because if the stove catches fire, then you can't get to the fire extinguisher right when you need it. It's like not having a fire extinguisher at all. And that's what they're doing with these backstops here. And it's also that they can finance their own customers to buy their product because nobody can afford their product if they don't do that, which means the demand is artificial. I've been saying it for years. They're all faking this demand. Broadcom stock, though, higher this morning by 0.9%, $362 a share, up by $3 and change. All right, now we got to talk about this one here. Apple announces new Mac Mini and Mac Studio models with AI upgrades. Pay attention to what Apple is doing. Most people view Apple as an AI laggard, and I think that's a mistake. Now, I don't own Apple, and I have no plans to buy Apple in the short term, but if there is a broader market pullback, Apple is one of those names that I would be looking to add to. or looking to buy, not add to. I don't have any position in it. With more consumers turning to Apple's computers for creating and running AI agents, the company is rolling out new Mac Mini and Mac Studio models with updated chips and other upgrades for artificial intelligence applications. The announcement a few weeks before Apple's expected to release new iPhone models shows how desktop computers have become strategically important for Apple as a foothold in the AI development world and as a showcase for the capabilities of its processors. Developers using software like OpenClaw to create their own agents often prefer to run them on a dedicated Mac Mini computer instead of in the cloud. And Apple's Mac Studio is a popular choice for AI researchers who are experimenting with training and deploying local models. That is so important right there, guys. People who are running these AI agents, a lot of them are running them on Mac Minis. They're not running them on the cloud. No data center required. It can run on local hardware, and Apple makes that local hardware. Now, imagine if AI goes the way of the computer, and instead of these big, giant mainframes in warehouses, they shrink to the size of the personal computer that sits on somebody's desk. What if AI does exactly what Apple did with the computer? Then all these data centers that they're building will be next to worthless because 70 to 90% of AI compute right now is used for inference. It's only 10 to 30% that's used for training new models, which means a lot of these data centers will have no use whatsoever if this becomes the norm, if people decide that they're going to start running AI on local hardware instead of paying by the token to use OpenAI or Anthropic's models in their data centers. With these frameworks and new chips, developers can run and fine-tune large AI models locally on their Mac, Apple said in a press release. The Mac Mini can now configure with two new chips, the M6 and the M5 Pro. It's the first Apple computer with an M6 generation chip, which is manufactured on a 2-nanometer process from Taiwan Semiconductor. Apple's highlighting Tuesday's announcement that it builds its iPhone and Mac chips with special parts called neural engines dedicated to running models, and that it uses RAM architecture that eliminates some memory bottlenecks. Apple stock right now is trading at $310, higher by about 33 cents or 0.1%. Again, I'm not a buyer of Apple here personally. I think Apple's still a little too expensive at 35 and a half times earnings. That being said, if we do get an unwind of the AI trade, and if everybody starts selling off these hyperscaler stocks, all this reversal of passive investing, Apple's going to get thrown out with the bathwater there, which would mean this one would go on sale. And then I think Apple is one of the first names to recover from that years later. So I've got my eye on this one for the long term. Meanwhile, the SEC reportedly subpoenas Wall Street banks over AI hedge fund situational awarenesses near collapse. Was this another Archegos? Is that where they're going with this? Let's read on, shall we? The Secretary of the Securities and Exchange Commission has reportedly subpoenaed several major Wall Street lenders to glean more information about their role in the near collapse of AI-focused hedge fund situational awareness. Regulators are seeking insights into situational awareness's trades, use of leverage, and communications with the investment banks, which included Goldman Sachs, JP Morgan, Citigroup, and Bank of America, according to Reuters, citing a source familiar with the matter. Situational awareness plunged from about $45 billion to around $10 billion in late July after it was hammered in last month's tech sell-off. The hedge fund, led by former OpenAI researcher Leopold Aschenbrenner, was forced to unwind much of its publicly listed portfolio of large, concentrated, levered positions, which included SK Hynix and CoreWeave, after losses sparked several margin calls among its prime brokers. Citadel's Ken Griffin's giant multi-strategy hedge fund stepped in to buy the positions at a discount, understood to be around 10%. Griffin said in an investor letter Friday that Citadel has since offloaded about 80% of the risk associated with the situational awareness portfolio. SK Hynix and CoreWeave have since rallied. In other words, Ken Griffin drank his milkshake completely and made a ton of money doing it. But look, all of a sudden, Goldman, JP Morgan, Citigroup, Bank of America, all these banks are getting subpoenaed by the SEC for their communications with this guy who, again, to this day, I swear, this guy looks like a Halloween prop that was made out of pool noodles. He's just skeeves me out. I can't help but wonder, is this another Archegos? Remember, Aschenbrenner used a ton of leverage, and everybody treated him like a genius. No, he was just a degenerate gambler. But remember when Archegos broke down, Archegos failed and cost a lot of banks billions of dollars because he was using these total return swaps, which are these highly levered bets, long bets on stocks. And you have to pledge collateral when you do this because the losses are potentially very large. And what Bill Huang over at Archegos did was he pledged the same collateral at 6 different banks to make the same trade. In other words, he committed fraud. And the fact that this guy, we know he used similar leveraged instruments, and we know he used several different banks to place those trades. I suspect the SEC is wondering, did Leopold Aschenbrenner pull an Archegos here? I guess we're just going to have to wait and find out what happens, what they see in those probes. But I would not be surprised to learn that the double pledging of collateral played a role in the collapse of this fund. And last one of the day, Taiwan issues indictments over alleged illegal export of AI servers to China. Oh, remember all those AI bros who told me, oh, you have no proof that they're selling servers to China. There's no evidence other than 9 people just getting indicted for exactly that. There's no proof. Taiwan prosecutors said on Monday they had indicted 9 people, including employees of NVIDIA and Supermicro, over involvement in the illegal export of artificial intelligence servers to China. Semiconductor powerhouse in Taiwan is the world's largest producer of advanced chips used in AI applications. Prosecutors this year investigated the suspected illegal export of server equipment with NVIDIA chips subject to U.S. export controls. Washington has imposed curbs since 2022, making it illegal for such semiconductors to be exported or sold in China without a license. 8 people, including 1 employee of NVIDIA's Taiwan unit and 2 employees of Supermicro's Taiwan unit, were charged with breach of trust and document forgery in connection with the illegal export of high-end AI servers, prosecutors in the port city of Keelung said in a statement. NVIDIA said its employees have every incentive to work diligently with customers to ensure compliance with all applicable laws, adding that it would work with Taiwan authorities to help them resolve the allegations as quickly as possible. Supermicro said its cooperation with Taiwan authorities led to the arrests of indicted individuals, including 2 former employees of its Taiwan subsidiary. I'd also add several Supermicro employees have been arrested here in the States, including the company co-founder, Wally Law. The company continues to cooperate with Taiwan authorities and is not a target of their investigation and has not been accused of any wrongdoing. I love how they say that. Like, other than the fact that our employees are getting arrested in multiple different countries, including our co-founder and board director and former CFO, but don't worry, the company is not the target here, just our employees and our co-founder. We've done nothing wrong. Guys, we all saw this was happening, right? As soon as sales of this stuff to China was made illegal, all of a sudden NVIDIA started selling a whole bunch of chips to Singapore and a whole bunch of chips to Malaysia. It was obvious that they were just buying using front companies in these countries, and it was obvious that Supermicro and NVIDIA knew that this was going on, but they're just playing dumb. Because when Jensen Huang is on stage or on an earnings call, we all treat him like he's a genius, but we treat him like he's freaking Forrest Gump when he's being asked about compliance with export controls for some reason. How about some consistent standards, folks? Anyways, we all knew this was going on. And while we're on this subject, I got to send a shout out to Kakashi on X, who has been following this for many years. He was arguably the first one to really drive home the fact that the AI companies and the chip makers were selling these things illegally into China. So Kakashi, job well done, sir. And guys, I just want to say thank you very much for having your coffee with the Melonheads this morning. Don't forget that like button and that subscribe button on the way out, should you feel so inclined. Also, thank you to my magnanimous Melonhead members on Patreon, YouTube, and Buy Me a Coffee for supporting the channel. You guys are awesome. There's links down below to all that good stuff. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.